Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Ladies and gentlemen, good morning. I'm Mattia Muesetti, and it's a real pleasure today to open our Focus on Insurance event, a morning of discussion shaped around the most defining shifts which are happening as we speak in the insurance industry today. If we take a step back, it's clear that we are at an inflection point. The world insurers operate today is a more complex, more data-driven, and arguably more exposed not only to volatility in the markets, but to environmental, technological, and regulatory risk. So today we'll hear from experts who are not only observing and navigating these shifts, but helping shape how to respond. And we'll begin with a keynote address on the future of insurance supervision in Europe, a theme that will inevitably influence how companies innovate, structure their products, and manage capital over the years to come. Following that, our first panel will examine the growing relationship between life insurance and private equity, private markets. We'll hear how insurers are navigating alternative investments, what it means from a wealth planning, liquidity, risk management, and regulatory perspective. Then we will move on to the environmental challenge. And in a world of increasingly frequent climate shocks, we'll explore how the industry is adapting through parametric solutions, cat bonds, and nature-based solutions, which are all, by the way, becoming core tools in the risk transfer toolbox. And finally, we'll end up with a conversation on artificial intelligence and how it's being applied to support underwriting and operations in insurance. So across this morning, we'll explore not only what is changing in insurance, but how insurance as a sector can make smarter, faster, and more resilient decisions in response. With that, it's my pleasure to hand over to our keynote speaker, Thea Jensen, Director General of Insurance Europe. Thank you very much, and please do enjoy our event. Thank you.
Thank you, Mattia, and thank you for the opportunity to speak for you today. The world is changing fast. We see it in the headlines every day: geopolitical tensions, trade wars and economic uncertainty, the accelerating effect of climate change, an aging population, and the ever-growing impact of digital transformation. These are not just abstract challenges. They have real consequences for people, businesses, and societies. And they require action. Insurance has always been about resilience, about helping people and businesses navigate uncertainty. But in this current world, insurers have an even greater role to play. Insurers are not just about paying out claims. They're partners in building resilience, in fostering stability, sustainability, and innovation. In uncertain times, they provide people with peace of mind and an extra layer of protection. That's why policymakers and insurers must work together to tackle some of Europe's challenges. In Europe and beyond, regulatory frameworks need to advance innovation, enable investment, and strengthen insurers' ability to provide the protection that people need. If you want economies that are resilient in face of climate change, cyber threats, or demographic shifts, insurance must be part of the solution. But to truly be part of that solution, the sector must continue to lead in three areas: climate resilience, investment, and innovation. On climate resilience, this is accelerating, and it is driving an alarming rise in natural catastrophes. Insurance plays a crucial role here, both with regard to recovery and in resilience building before disasters strike. The industry does this by providing financial protection, driving climate adaptation, and supporting migration efforts. And as Europe's largest institutional investors, they also help finance the transition to a more sustainable future. Speaking of investments, tackling Europe's investment deficit is crucial. And with the European Commission's recently launched Savings and Investment Union initiative, there is an opportunity to mobilize savings for productive investment. Insurers in Europe manage 9.5 trillion euros in assets and direct nearly 70% into EU equities and bonds. And in doing so, they're helping to turn household savings into economic growth. A regulatory framework that supports long-term investing will further enable to drive Europeans' green and digital transitions. This brings me to innovation. Insurance is being transformed by digitization. It is reshaping how they assess risk. It helps them improve fraud detection and, perhaps most of all, it facilitates an improvement of the journey for customers. Artificial intelligence, data analytics, and digital tools are not just about efficiency. It's about making insurance more transparent, more accessible, and responsive to the needs of individuals and businesses. But as a sector, we face a challenge. Insurers operate within strict regulatory frameworks, while big techs entering the space do not. Policymakers have an important role to play here to ensure balanced oversight across all market players. Innovation should drive competition, not distort it. All of this brings me to the key element of sound supervision to ensure a strong and effective insurance sector. The implementation of Solvency II has been a significant milestone in harmonizing insurance supervision across Europe. It's played a crucial role in making Europe's insurance sector one of the most resilient in the world. Even before the implementation of Solvency II, the European insurance sector demonstrated strength and resilience, dealing with major challenges like the global financial crisis and the EU sovereign debt crisis. Building on this inherent strength, the Solvency II framework was introduced to enhance and sustain this robustness in an increasingly complex and dynamic environment. Today, we have a single rulebook that enhances financial stability and policyholder protection while promoting cross-border activity within the single market. The system is working well. We've seen significant progress in fostering a more harmonized insurance market, where national supervisors supported by EIOPA effectively oversee the industry and at the same time take into account national differences in taxation, health, and pension systems. This balance between European coordination and national expertise is essential to maintain an efficient and effective supervisory structure. Looking forward, it will be crucial that Solvency II evolves in a way that allows insurers to maximize their contributions to society and the economy. That means ensuring that the framework remains risk-based, proportionate, and fit for purpose, supporting long-term investments and financial stability without unnecessary regulatory burdens. There are three things I want to mention here. Looking ahead, insurance supervision must adapt to the increasingly complex risk landscape. Climate change, cyber threats, and macroeconomic uncertainties pose new challenges. EIOPA and national supervisors have been proactive in stress testing extreme scenarios, consistently finding that the industry remains robust. The priority should therefore not be to introduce more layers, but rather to ensure that existing regulations are implemented and enforced effectively. We need a smarter, more proportionate approach to regulation. It must strike the right balance, ensuring financial stability and consumer protection, while allowing insurers to operate efficiently. A smarter, proportionate approach will foster innovation, encourage long-term investment, and enhance competitiveness without creating unnecessary burdens. Another key priority must be restoring and strengthening consumer trust in insurance. This means ensuring that products are transparent, accessible, and designed to meet the diverse needs of European consumers. However, it's also essential to recognize that trust is not solely a regulatory issue. The industry itself must take the lead in simplifying communication, enhancing financial literacy, and improving the customer experience. Regulation should facilitate, not hinder, this process. In conclusion, the future of insurance supervision in Europe build on the strong foundation that we have already laid. The Solvency II framework, combined with strong national supervision and European coordination, provides a stable and effective system. While targeted improvements, particularly in cross-border supervision, are necessary, a complete overhaul towards a single European supervisor would be costly and an unnecessary distraction. Instead, we must focus on making regulation smarter and more proportionate, ensuring that it protects policyholders as well as enable insurers to operate efficiently and innovate for the future. If we get this balance right, we can continue to strengthen the European insurance sector, ensuring that it remains a pillar of stability and security for generations to come. I wish you all a very good and insightful day of discussions. Thank you for your attention, and I hand it over to Marc Hengen, who will moderate the next panel. Marc, the floor is yours.
Good morning, everyone. Before we begin, I would like to extend our sincere gratitude to Thea, Director General of Insurance Europe, for her insightful keynote. I'm Marc Hengen, the CEO of the Luxembourg Insurance and Reinsurance Association, the ACA. Welcome to today's panel discussion on the evolving relationship between the insurance and private equity. I'm joined today by Theodorovics, CEO of Baloise, Luxembourg, and by Alexandre Draznieks, CEO of Cardif Lux Free, and Gilles Dusemon, partner of the law firm Arendt from Luxembourg. Luxembourg life insurance have resumed with a sound growth of 41% in 2024, totaling 26.8 billion of new premiums for a total of 242 billion of assets under management. Today we will focus on private equity as underlying assets in life insurance. Our discussion will cover three thematic parts. The first one being about market trends and investment strategy, with a focus on how and why life insurers are integrating private equity into their portfolios. So, Alexandre, let's start with you. What is driving life insurers' increasing exposure to private equity?
Good morning, Marc, and thank you for your question. And yes, indeed, private equity is drawing keen interest, I would say, from life insurance, and that is since many years, I would say. I see three main drivers behind this trend. The first driver is that private equity responds to the needs of diversification. And when you speak life insurance, you basically speak wealth planning. And from that perspective, private equity is long-term investment with much higher expected returns. The second driver is that here in Luxembourg, the life insurance regulation has, I would say, always provided a very favorable framework to private equity investment. And the third driver I see is that this open mindset, so to speak, for private equity in life insurance has somehow spilled over to other countries. And this is the case in particular in France, where the regulation in life insurance has softened or liberalized, Loi Pacte, Loi Industrie Verte, actually towards private equity investment in some specific sectors.
Okay, thank you, Alexandre. So, Christine, given the Luxembourg unit-linked framework for life insurance, how are private assets being structured within this life insurance from a wealth planning perspective?
Hello, Marc. Hello, everybody. Well, rather than restricting the discussion only to private equity, I would say we're talking about private assets. And that's a little bit more than private equity. It's equity assets, but also private funds. It's private debt. So there's much more to it. And I mean, why do we do it? Because we can. I mean, in Luxembourg, we have a very favorable regulatory environment to do that. And that's an opportunity we all use in the interest of our customers. So as Alexandre already said, there is a demand in the market. Our customers are typically high net worth individuals, ultra high net individuals. They are used to have access to all sorts of different investments, also private assets in all types and forms. So why not use them also to estate planning and their other investment potential? So that's what drives us. It's a diversification. It's a profitability question. It's just something we need to live up to. And how do we do that? Well, in Luxembourg, we have the possibility to have the policies backed by insurance investment vehicles, by different internal funds. So that's the means how we can provide that to our customers. And the customers is the main point of attention because we cannot provide that to everybody. Obviously, we make a very thorough process to very special investors with a certain risk profile where we can offer those solutions.
Okay, thank you, Christine. And the next question would go to Gilles. So with the increased allocations we were just talking about to private assets, are you seeing changes in how private equity funds themselves are being structured?
Thank you, and good morning, everyone. Well, you know, the buzzword right now and for more than a year is democratization of real assets and democratization of private equity in particular. And we are seeing the most important private equity houses around the world, most of which have operations, by the way, here in Luxembourg, to expect a significant shift in their fundraising to go towards retail investors, away from the more traditional institutional capital sources. And when you look at the life insurance sector, well, it is sitting neatly in between this kind of institutional approach and the ultimate high net worth individual that qualifies from a legal point of view as a retail investor. And so the Luxembourg life insurance market and its open architecture, and at the same time the Luxembourg fund segment with its offering in the private equity space are coming together. And we are seeing there a combination which is fully in line with the trend that we are observing at an international level. But more will happen over the coming months and years, because this trend is clearly marked also in new products. For example, I may mention the LTIF 2.0 regulation, which is really trying to bring private equity to a retail public. And yet again, this may be the next step for also life insurance and insurers to look into and to tag along. And last but not least, in respect of these trends, we see private equity houses adapting more and more towards the needs of life insurers and the products they're implementing with better and increased reporting and adjusting basically to the needs of that segment. Okay,
thank you, Gilles, for these specifications. Let's move on to the part two, which will be about risk and liquidity management in private assets, and with a focus on how life insurers and asset managers balance long-term investments with liquidity constraints. So, Christine, how do insurers navigate the liquidity challenges of private assets while ensuring policyholders and beneficiaries are protected?
Well, that's a very good question, because this is one of the specificities of the private assets. And I just remind us the private assets, in order to be compliant, they need to be either private funds, private bonds, or private equity. And it's also not available to everybody. It's available to a certain kind of type of clients. And we need to make very sure it's type C and D clients. So that's defined very strictly what that is. And those are typically clients who should be able to grasp the concept and who should be prepared to deal with this lack of liquidity. So first step, obviously, the right assets and the right choice of the clients, or the accessibility for the right clients. The other thing, obviously, which is very important for us as an insurer, is to have the right procedures, the internal rules, procedures, processes, how we underwrite those risks at the end of the day, or those policies. That means, on the one hand side, as I already mentioned, to the right people with the right rules underlying. You can have that in side letters. You need to check every single policy whether this is really, in the case of the lapse of the repurchase, there is liquidity, and if not, that you define the rules beforehand and not afterwards. So that's very important. On the other hand, obviously, from the insurer's perspective, you need to check on the solver. I mean, that has a different impact on solvability, whether the underlying is liquid or not. So that's also why you have usually a certain amount of liquidity which is provided within the policy. So that's a rule which you establish within your own house, insurance house, but that's quite a general assumption that you agree with the client and you have a certain amount in your policy of liquidity, so you already provide for that. But the most important thing of all this is that you have a very, very specialized equipe, the team. So you need really specialists. Those are highly qualified, legally trained people, and we have that. And they can really sit down with the client, discuss all that, make them aware, and then the client, he can sign up and say, okay, that's exactly what I'm in for, and that's the consequences which are out there.
Okay, so thank you. The liquidity challenge is well taken care of by the insurer. So, Alexandre, what are the challenges emerging as policy transfers from one person to the next, or generation to generation, in succession planning, and with an example of transfers of shares?
That's a very legitimate question. As we know, succession planning is one of the objectives or the merits of life insurance. To be clear, I would say that tax-wise, there is nothing specific about private equity in life insurance. It benefits from the same succession regime as any other investment within the life insurance policy. Now, the question is more, if I put some private equity investment into the life insurance policy, will the illiquidity of this investment compromise somehow the transfer of this wealth to, let's say, my children? And the response there is no, because you don't need actually to liquidate the investment. You can indeed transfer, let's say, the shares of the investment. But the issue is the following. Beyond this general response, there is actually a lot of subtleties. And I'm just giving you one, and you will understand. There are some private equity funds which are reserved to professional investors. And when those funds are within the insurance policy, then of course the professional investor is the insurance company. But this is far from obvious when you are speaking about physical person. And when the time comes of the transfer of those private equity shares to the physical person, then you might have a problem. And that's the reason why I'm very much actually concur with what Christine was saying, in the sense that all of this points out to the fact that whilst the transfer of the shares is possible, you need a lot of expertise, as well as, I would say, a lot of coordination, strong coordination between the various stakeholders which are involved in all that process.
So the expertise is key in doing
Indeed.
Such an operation.
Indeed.
That's good. So, Gilles, what key considerations should insurers keep in mind when increasing allocations to private assets as regards liquidity? Again.
Well, we heard one constraint about, let's say, the professional investor, but on the other side of, let's say, of the legal side is the management of the liquidity in respect of traditional private equity funds, because private equity funds are designed as closed investment funds. You can invest, but you cannot get out when you want, but you can get out as the fund is realizing its investments. And so as the fund is realizing its investments, the fund requires additional liquidity. And that liquidity must come from the insurer. So there must be a match of funding commitments between the client towards the insurance policy and then the insurance policy towards the underlying private equity fund. And that has to be managed because there cannot be any risk of default because it would have reputational consequences in all directions. And so that's why liquidity management is key in this relationship. Now we are seeing in the market products change with semi-open type of features, but let's say the traditional private equity fund is a closed box type of fund where money needs to be paid up over time and then will come back over time, and there will be no real room for in-between liquidity management unless it has been carefully planned.
Okay. Thank you, Gilles, for these precisions. So let's move to part number 3 about the future outlook and some regulatory considerations with a focus on structuring considerations and the future of private equity in life insurance. Christine, looking ahead, what can we expect to see in terms of market shifts and how insurers structure their unit-linked products?
Well, the whole private asset market is extremely dynamic. It's moving very fast. So it's very important to move along as an insurance provider because our clients expect us to move along. So the first change, I would say, or the first influence we have, trend, is really the client side. The clients, they're demanding, they want more profitability, more flexibility, safety, everything transparent. So we have to be there and adapt to their needs all the time in order to stay competitive. And at the same time, obviously, the regulation, is also there and tries to adapt. So you always have to be ahead of the curve. And that means that we try and we are adapting our products and our propositions all the time with the needs of the market and also what comes from the private asset issues, because they change their assets all the time as well. So if we want to work with them and if we want to be up to speed, we need to include those, and we need to, again, with a very specialized team, analyze those new forms of assets all the time and reassess them, whether we can use them and how we can use them. There are lots of constraints, obviously, and what we don't want is to provide our clients something which hasn't been checked before. So there are also new trends, obviously, and regulations which need to be respected. Clients ask for more sustainability, ESG funds. There is the value for money question, which needs to be respected. Obviously, all the question about the economic substance, which needs to be respected. But for me, really the most important thing is that we, as an insurer, we need to be proactive, adapting our products, internal processes. The main word I would call really anticipation. It's a fast-moving target, and to be very efficient. And by efficient, I also mean to adapt the tools, digitization, and also to use AI in order to really go with the flow and be efficient, because this is exactly what our clients are expecting us to do and our business partners.
Okay, thank you, Christine. Gilles, from a regulatory perspective, are there any developments regarding private asset structuring within life insurance you see?
I think for once on the regulatory front there is not too much coming, or what is coming may be perceived as positive. We have Solvency II on the one side, which is expected to bring further alignment, and so between regulatory capital charges and the actual long-term value of private equity. And so there we believe that this will allow insurers to channel more money towards private equity investments. Then we have another regulatory development, which is one which is touching upon the funds industry at large, AIFMD2, which will go into implementation next year. This will bring additional reporting obligations, but we believe that these can be managed. There are none which will have a specific impact on the private equity asset class, but there may be impacts and adjustments on the private credit side, for example, to the extent that may also qualify as a real asset category. And then in the Luxembourg context, otherwise, I think we are pretty well set up. There are a number of practical and organizational aspects that need to be sometimes organized when we put this into the Lux context, but otherwise it's relatively clear long term.
That's very good to hear. So thanks for that. Alexandre, to conclude, May I ask you what role do you see insurers are playing in the broader private markets in the coming years?
Well, that's a very broad question and a good one given the, I would say, the sheer size. Life insurance is, let's say, injecting savings into the real economy. So that's a very legitimate question. To put it simply, I would say, yes, the insurer will have and have actually some significant role actually in this respect at two levels, though I would add some words of caution I will detail. The first level is insurance companies which have general funds or Euro funds can and really do invest actually those general funds into private equity or private, more generally, more broadly, private assets, as Christine was saying. Now, of course, this has to be done in full respect of solvency and risk policies, which Gilles was mentioning before. And there are breaks on that, and for good reasons. And it has to be respected, of course. The second level is, let's say, the unit-linked investments, which are channeled through the life insurance policy into private equity or private assets. And I would say that there, the key factors is the flexibility of the framework, life insurance framework, which makes possible those investments into private equity. There are currently discussions here in Luxembourg to, let's say, improve and develop this framework to make it more flexible. But at the end of the day, as a financial hub or as a, let's say, insurance hub, this is very important for all of us to find a very well-defined balance between this flexibility, the risk it entails for the consumers or the insurance taker, and therefore actually the protection of the insurance taker. That's what we have to find as a financial hub or insurance hub.
Okay. Thank you very much, Alexandre, for these words. It is now my duty to conclude this panel. I think we can say that private equity in life insurance are sophisticated solutions to clients' needs, and the solution is improving, is getting more asked for. And as a conclusion, I would like to thank you, all the three of your experts, for your contributions. I would like to thank Luxembourg for Finance for putting up this webinar. And I'm passing the stage now to Maria Mateo Iborra, the CEO of the IBISA network, for the fireside chat on insurance and weather risk transfer with Lize-Mari from Swiss Re. Thank you. Bye-bye.
Good morning, everyone, and welcome to our fireside chat on insurance and weather risk transfer. First, a warm thank you to Marc Hengen for the insightful discussion in the previous panel. I'm Maria Mateo, CEO of IBISA, and IBISA is an insurtech that is focused on climate risk in underserved markets. We create innovative solutions that protect people and business from risk, like a typhoon, extreme heat, or droughts. And I'm truly delighted to be joined by Lize-Mari Barnes, CEO of Swiss Re Luxembourg and Global CFO for P&C Reinsurance. Today, we will explore how the insurance industry is adapting to the extreme weather and how solutions like parametric insurance are expanding the boundaries of who and what we can protect. Let's dive into it. Around the world, extreme weather events are increasing in both frequency and severity. The recent earthquake in Myanmar, the California wildfires, floods in Valencia, heat waves, droughts. As climate risk intensifies, the role of insurance becomes even more vital. And reinsurers play a critical role in helping the industry adapt, absorb shocks, and innovate at a scale. Lize-Mari, given the global surge in catastrophic events, how is the insurance industry adapting? And how are parametric insurance helping tackle these emerging risks?
Hi, Maria. Hi, everyone. And thank you. It's a pleasure to join you today. So parametric insurance solutions are provided for a variety of perils. The most common is earthquakes and hurricanes. And parametric insurance solutions are a true complementary or traditional insurance. It pays claims fast, and it has very transparent triggers for payment. It can also cover non-physical losses, for example, for payments, like emergency payments to municipalities when events happen, but it can even cover non-damage business interruption losses. So it's truly helping to close the protection gap. Now, it's important for parametric insurance solutions to be part of a risk management program, but it's actually most effective and successful if it's part of a broader risk transfer strategy. Now, parametric insurance solutions does not come without any risk. The most significant risk is actually basis risk. So that is basically either when an event happens, but the insured are not actually paid, or when a payment is done, but the insurance event has not actually triggered. Parametric insurance solutions are really deployed to solve specific concerns. It could either be mitigate areas of specific concentration. It can be access to fast claim payments for specific catastrophes, the ones like you mentioned. But it can also cover certain events of a certain strength or magnitude. Maybe just a few comments on what makes parametric insurance solutions really different from traditional insurance. Traditional insurance has things like sublimits and retentions, which is not the case for parametric insurance. On the reinsurance side, it is quite similar, but actual payout is based on factors. Parametric insurance also helps not just in terms of addressing low penetration, but actually addressing financial losses in the case of true economic loss events. So it's truly complementary to traditional insurance, but also addressing all the various areas as you introduced it.
Thank you. And following on that, could you share some examples of risk transfers, strategy, and services that can help insurers?
Sure. So important that the weather risk market is a niche risk class that covers a wide range of products, including coverages that are linked to air temperatures, precipitation, river flow levels, wind speed, solar irradiation, and the like. Weather risk coverage can really be structured to protect either from extreme weather events, that is, high severity and low probability, or seasonal weather anomalies, where there is actually medium to high severity and high probability. Now, important that weather risk has been mostly traded in the form of derivatives because of hedging needs of the energy industry. Energy companies are very exposed to commodity price risk that is volatile and sensitive to seasonal air temperatures. But it can also trade in the form of parametric insurance solutions, as we just discussed before. We actually have a flagship product in the market that is a temperature quanto derivative structure. So this basically offers energy price risk protection to clients when weather is either too cold or too hot. And this is key for energy market players, especially during this time of key weather risk and as we transition towards renewables.
Thanks a lot. And I think also to growing challenges, there is as well growing solutions. So we are seeing a significant rise in catastrophe bonds, CAT bonds, that is a way to transfer climate risk to capital markets. And just in Q1, there is 7 billion already issued in CAT bonds. How do you see the role of CAT bonds in building global resilience to extreme weather? and what do you think is needed to scale them further?
Sure, so I will cover a little bit the products, the growth and the scalability. So in terms of product, cat bonds are a risk transfer tool issued by insurers, reinsurers, corporates and sovereign nations. And it enables an alternative source of claims paying capacity in the event of extreme catastrophes. The coverage really enables the world to rebuild after a NatCat event. For insurance, it actually provides the ability to pay out claims to policyholders. And for sovereign nations, cat bonds is part of a broader disaster risk financing plan to enable reconstruction and rebuilding. Types of cat bonds cover most common NatCat perils, as discussed, but there's also a smaller market for life and health, such as extreme mortality or extreme morbidity, but also cyber bonds. In terms of growth, so clearly the ILS markets continue to grow very actively, as you just stated yourself. We've seen more than 17 billion issued in 2024. We've seen approximately 50 billion in coverage outstanding, and it's growing approximately 10% annually in terms of notional outstanding. And this translates to approximately 300 unique bonds in the market as at the end of 24. Now, there's a number of factors that actually influence the growth of cat bonds. The availability of capacity in the traditional insurance space, capital market investor demands, recent NatCat events, type of risk perils actually covered, but also risk models, quality and availability. And the market continues to evolve each year with new perils, new geographies, and new sponsors. In terms of scaling, sustained growth depends on a relative balance between supply and demand, and the continued education and exposure of this asset class towards investors and sponsors. In terms of a potential investor perspective, cat bonds are sophisticated investments, and normally it takes some time to understand the asset class enough for them to actually participate. From a sponsor perspective, not every type of NatCat risk is immediately transferable to the capital market. So sponsors might not know how and if a cat bond is the right tool for them. So there's a sweet spot of risk type and risk level for this type of coverage. In terms of risk type, cat bond arrangers are continuing to evolve in terms of innovative structures and products. And in terms of risk level, it is estimated and expertised by third-party modeling firms. This is a very important step required in every transaction. And models are continued to be updated in terms of list of perils, but also in terms of geographies covered.
That's a fascinating type of products. Another key element is not just to transfer the risk, but also how we increase adaptation and resilience. What opportunities do you see in linking insurance with conservation and resilience building initiatives?
Sure. So clearly from a costing perspective, our models already integrate historical and observed trends and assumptions on future exposure, developments and forward-looking trends. But also in terms of assessment of risk, it integrates preventative measures if no historical data is actually available. The opportunities are multiple. Most common is really risk engineering consultancy services that are offered by many insurance companies to reduce risk and increase resilience. And examples of this is fire protection methods, but also workplace safety recommendations. There's also a growing market in insurance products that insures natural resources and natural infrastructure. And here a concrete example that I can mention is coral reef insurance. Also in terms of the weather risk transfer perspective, the opportunities are multiple. Opportunities in terms of the transition to renewables, increased demand for coverage that will grow as weather risk actually increases, especially for energy providers. We have opportunities for new products and solutions to address the challenges of climate change and to increase resilience of societies in general. We also have an example of where we structure NatCat deals that actually offer innovative products for coastal protection in case of hurricanes or extreme weather events.
And linked to that, how do you see the technology and data analytics transforming the next generation of reinsurance?
So clearly a very important topic. So extreme weather is becoming more frequent and severe. And that means it makes our historical risk models less reliable. Our industry must evolve beyond historical data towards real-time predictive insights so that we can develop more responsive and efficient weather risk transfer solutions. There are certain opportunities in AI and predictive analytics that will allow real-time satellite and IoT data for us to actually do better risk assessment and price adequacy. In terms of parametric insurance solutions, we covered that, but this is clearly an opportunity to reduce delays and increase accessibility to insurance. And in terms of risk protection and customization, insurers can afford tailored, proactive solutions from early warning systems to dynamic pricing, shifting focus from pure risk transfer to actual risk mitigation. So to conclude, the fusion of data, automation, and AI is reshaping weather risk transfer. To stay ahead of climate volatility, we have to embrace the innovation to ensure we can make insurance coverage faster, fairer, and more adaptive to evolving risks that we face as an industry.
Thanks a lot, Lize-Mari, for this really insightful exchange. We have heard about how the industry is adapting to the growing climate events, the role of parametrics, cat bonds, and also the important aspect of adaptation and resilience. So thank you so much for sharing the reinsurer view. And thanks also to Luxembourg for Finance for bringing us together. And now I'm pleased to hand over to Marc Lauer, CEO of Foyer, for the next chat on AI to support better decisions and speed underwriting. Thanks a lot.
Hello. First of all, I would like to thank Maria for that very interesting interview she had with Lize-Mari. My name is Marc Lauer. I'm CEO of Foyer and also Vice Chair of the Luxembourg Insurance Association, which is called ACA. Today, we speak about AI. Very hype subject. Everybody speaks about it. Just recently, we had the discussion. We learned that in Paris, there were more than 300 billion announced of investments in that sector. AI is also a topic for insurance companies, and I'm discussing this today with Gilles Dubuisson, which is a licensed manager of Convex Europe here in Luxembourg, and also the chair of the International Insurance Non-Life Committee at ACA. So, Julie, where do we as a sector use the most for the moment AI?
Well, good morning, Marc, and thanks very much for having me this morning. I can also reassure our viewers that we've got the genuine Marc Lauer on stage today and not an AI-generated image. Indeed, our industry couldn't do anything without AI. And even if there's been this growing trend, especially since 2023, all the generative AI models we've seen appearing on our markets since 2024 and 2025 have demonstrated the huge potential for our industry. Especially, we are one of the few industries in the world which can benefit from a huge amount of data. And one of our key challenges was always how do we treat this data? How do we use this data as an added value? And AI is there to support us tackling this challenge. So far, where we've seen AI implemented within our industry, that it's mostly around fraud detection. especially right now, we all know what a deepfake is. We've seen actually claims submitted using deepfakes or shallow fakes, and AI allows to actually identify those tentative, of fraud. We are also using AI as a key element to automate processes, automate the way we work, and eventually provide a better experience for our colleagues and also our policyholders. There's there's a one point really important as well, which is the customer experience, and where we also able to provide interaction, better interaction with our policyholders, having the chatbots on websites, providing a better customer experience all along the way and through the value chain of the insurance, underwriting, and claims handling processes.
Well, that's a large field. I think where insurances nowadays can earn a lot of efficiency and operational efficiency is in the back office, in the claims handling. I think it should be normal to have an ambition as a retail insurance company over the next 5 years to handle 50%, eventually 70% of the claims fully automatically. So we have a lot of things in front of us, a lot of good things. Where do you see the challenges of AI?
Well, I think we, within our insurance industry and reinsurance, especially in the underwriting world, we keep talking about the augmented AI underwriters or augmented AI claims handlers. And we all wonder at some point, what does that mean? Especially, how do we better leverage AI to actually save us some time to focus on added value activities, while the more cumbersome activities could be dealt with by AI. And I think this is really this challenge, finding the fine line between both worlds, making sure us as humans remain heavily involved, and that the AI models are remain contained within a framework that is acceptable from an ethical and potentially regulatory point of view. And this is what we see more and more, especially with the European AI Act.
I think Europe has been really a pioneer in regulating. Let's see if that regulation really will be shaped in such a way that it helps develop AI in a good way, or if it just is, again, a question of competitive edge to China, US, and so on. But I think for the moment at AI, we dream a lot. We have hundreds of ideas, millions of ideas. The real challenge is to not only to do a proof of concept, but to bring these real ideas into the production line, into our processes. And I think there a lot of insurance companies still have quite a lot of problems. So it's not the ideas missing, but it is definitely the mise en production, to get it going, which is difficult.
Absolutely.
Do you share this?
I agree with you, and also to reach that production stage, what is also required is some investment. Obviously, when you've got a team coming up with a proof of concept, trying to demonstrate that there's going to be some time saved for various teams, within the insurance company, that there will be some improved data analysis, portfolio optimization, finance, accounting, review. In front of that, you've got a cost. And you always go back to the cost versus benefit ratio. And I think the challenge is first to be able to convince the leadership and have a harmonized approach from a leadership point of view, that there's a real benefit, at pushing those projects forward in order for them to reach the production stage.
You touch an interesting point, AI and human beings. How do you see the evolution over the next years? Will AI destroy all the jobs? Will we have different jobs? What will happen in our insurance sector?
Well, what I've seen on the large risk, complex risk markets, especially on the London market and also in Luxembourg, is that when you focus on the underwriting side, for example, going through engineering surveys or bespoke wordings, for large international companies, it takes a lot of time, especially when you've got 20 surveys or reports that you have to review within a very short amount of time. Well, AI in real life, and what we're seeing right now on our market, allows you to save, to go down from 3 hours of spending time reviewing and analyzing those documents by yourself, by potentially missing out on some key information, to 15 minutes. And that saves you a lot of time to actually spend more time on assessing the risk and be able to go back to your broker or your policyholder with the relevant answer in no time. So that's really where I see the added value as of today.
I do too. I think it's very interesting. There's one large American company who calls their large language model, which they propose now to their clients, co-pilot. And I think the word is so good because humans stay the pilots, but they will get helped a lot by AI. So, AI in 5 years, where are we? What's your view?
Well, I do hope that the way we've been working as humans and insurance professionals with AI will continue, and follow this path, again, of having a genuine balance, between both worlds, and again, leveraging AI to allow us to make better decisions in order, again, to maximize, the profitability of our portfolio, to provide our policyholders, with a better experience, and also to be able to follow any new regulation potentially in a very easy and efficient way. So I would say same trends, but again, we still have to remain cautious and aware that AI still needs to be managed and not left on its own or uncontrolled.
So a bright future for AI and for the insurance sector?
Absolutely.
Thank you very much, Julie. And I will pass now over to Matthias.
Thank you, Marc.
Thank you very much, Marc, and thank you to all our speakers throughout the morning, from the future of supervision to private equity in life insurance and how artificial intelligence and weather risk transfer are reshaping the industry. Today, we have had a clear snapshot of both the challenges and opportunities ahead for the insurance sector. What stands out is the shared commitment across our sector to adapt, collaborate, and lead. On behalf of Luxembourg for Finance, I want to sincerely thank all of our sponsors for their continuous support in making and supporting in making these events, and of course, the audience for joining us today. And I invite you to stay connected, keep the dialogue going, and join us for future events. Thank you very much, and enjoy the rest of your day. Bye-bye.